Labels. Okay, so here's where we are. So I'm going to cover today some stuff, some examples and some issues that you're going to run into in 4, assignment 4 and homework 4. Because in that chapter, this is the only new stuff we learned. This is stuff we've been doing. You notice it's getting right down to we just practice discounting. So most of the stuff in chapter 4 is discounting relative to the private business. And I've been blabbling about it. So I'm going to go through some key examples. And then next week, and Tuesday is a holiday. So we'll just have Wednesday and Thursday. But they might be a little longer because I want to get through chapter 5, which is very difficult. As far as understanding it, because it's all economics. Once we get through chapter 5, we have enough for all the undergraduates to have these webinars, which I will force myself to figure out how to load on YouTube. And then everybody can just get them from YouTube. And the undergraduates basically have a full set of lectures. So what I'll do then is just start handling problems. And then the graduate students, we really only have, I think, 4 or 5 additional assumptions, homeworks or assignments, I guess they are. And so I'll just cut those lectures. Promise you, it gets much more interesting and fun after chapter 5. So we will hele on through those because they're very straightforward. This is really, we're right now in the slog where you really learn how to set up these discount tables and how to look at these different points of view. And then I will also work with the undergraduates on getting projects, or post webinars relative to the projects, final projects, because I've posted some stuff. So you can do that one, or you can do one of your own choosing, depending on what you want. But you really pretty much, you're just down to doing homeworks and assignments. And if you can get through those, this is really pretty well handled. I know that I've only had one person that's now really on the 2s, assignment 2, homework 2. But a lot of people are done with 1. So I think that it's going to get a lot easier now because you've understood how to do discounting. This was our nightmare. So we're going to share. First thing we're going to do is go to a PowerPoint and hopefully... what is this? Okay, this is not the one I want. So I'm going to stop share. I want topics. So I want to share topics. Oh, goodness sakes. Come on, share the one I want. Word. Let's try that one. No, that's not the one I want. Topics. It's this one. That one. Oh my God. They're all the same. I'm not going to close them. Okay. Okay, now we only have one open. We should be good. Okay, finally it's the one I want. All right. So let's put you guys to the side. Let's blow this up a little bit. So, we're going to go to slideshow, so I don't think we need to. Okay, so here we go. We are going to talk about topics on assignment and homework 4. Now, first thing I want to talk about is this problem with depreciation. I've been kind of blabbling about it a little bit, but let's talk about what this actually looked like. there's different types of depreciation, and it's all controlled by the tax people, which one you get to use for certain things. Equipment that moves around, like engine type stuff, cars, vehicles, tractors for farmers. Equipment wears out very quickly, where things like buildings do not. But at the end of the day, even if it wasn't controlled by the government, we really do want to look at depreciation. So what is depreciation exactly? Depreciation is the fact that something becomes less valuable. It just gets worn out. A house gets worn out. A roof only lasts so many years and you have to replace it. So every year you technically use up a little bit of it. So for the private business, when you calculate those net benefits, you have to worry about those operating expenses. And it's really important because a lot of times this private stuff is crucial when you're trying to do a project. Like say, for example, you're buying a machine and it costs $10,000, okay? And you know that you're going to get $20,000 a year worth of income as a result of owning this machine every year for 5 years. But then at the end of that time, it's completely used up. So why are we talking about this? Well, you've already spent the $10,000 in year 0. So that shows up as a minus $10,000 in year 0. But what happens is every year that that machine wears out, it reduces your taxes. So you have to figure out what's the impact on net income, because we don't want net income. What do we want? What are we calculating in a benefit cost analysis? Not net income. We're calculating net benefits. Net income is an IRS accounting number. What we want to know is how much benefits did we get from buying the machine? We got 2 different sets of benefits. One is the income we got from buying and using the machine, and the other benefit we got was this fact that we can get depreciation. So that reduces our taxable income, right? So we have to figure out what that benefit is so we can account for it, because otherwise if we just take net income, what we're doing is we're saying, okay, so we got to subtract the cost of using up this machine, but that's not a cash benefit. So that net income is not equal to net benefits. The net benefits are different because subtracting depreciation is something that the IRS lets us do, but it doesn't involve any cash, so we don't need to discount it. We've already accounted for the cash that we spent buying the machine. We don't want to account for it again by using net income. So we have to take a backtrack. And what I'm going to show you, there's one problem. It's also in your BCA overview. You're going to do it exactly like this. So here's what we're going to do. We're going to figure out how much this machine goes down in value every year, and then what the tax implications from that are. So if it goes down in value completely, $10,000 becomes worth 0 in 5 years, then we have to spread that over 5 years, that decline of the $10,000. And we would do that in our taxes. And this owner uses straight line depreciation, although the IRS would probably not allow that. In this example, it's the easiest. And in your homework, it's the easiest, just so you can get a feel for what you're doing. Because if you're working with a government project and they've got private businesses involved, you're going to have to understand, how to make sure that you keep them honest in their net benefits projections, because this can distort them if you include depreciation, and that's why we're talking about it. Because a lot of times the most productive ways to do things is with private partnerships. But once you get in with private partnerships, I'm just going to be really honest, accountants can be very creative, and we need to understand how they do that so that the project does not end up benefiting the community less than it should. We always are very suspicious of businesses, particularly large ones. So we try to be very careful before we assume that they're going to be making all this money. Because if you don't understand accounting and you don't understand how they're making their business decisions on the private benefit cost analysis, then you're not going to be able to negotiate the best deal. And that's one of the reasons why we're learning about all these different points of view, because we really want, in this class, I think, an understanding of how to make that community the most sustainable that it can be. And we're already starting from a disadvantage when you have a private business, which oftentimes will have a very high cost of waiting. So they won't really be a long-term partner in the community sometimes. And so we need to be vigilant before we start doing these private partnerships. And this is why we get suspicious of businesses. I think we should not be suspicious. I think we should educate ourselves and understand their motivations and understand that they're driven by profits, not criticize, but learn how to do the calculations so that we can manage that relationship. Life is about relationships, and we need to manage them by understanding how to do that. And that's what we're doing in this case. So you have no salvage value. So that means it goes down in 5 years. We drop $10,000 in value off this machine. It's worthless at the end of 5 years. And you use straight line depreciation. What that means is it drops in value the same every year. Usually a machine will drop in value the first year a lot, and the last year's not so much. Those are called accelerated depreciations. In this case, to make it easy for you, I just did a straight line. For me and my business, I actually have a spreadsheet that does the depreciation calculation for me. I just make a decision on what government schedule I'm allowed to use: 5 years, 7 years, 15 years, or 20 years, or 27.5. So there's like 5 different options for me. I check my box, and then I have a software developer. My son has developed this software, and I check a box and it automatically calculates for me. So for you, I've made the examples easy. We're going to use straight lines. So that means it falls an equal amount every year. So $10,000 divided by 5 is $2,000 a year. This thing just drops in value. So that's the actual amount of depreciation. And then lastly, we need the tax rate, because we need to know the tax implication of that reduction in cost, because that reduces our taxes. If we have a $2,000 reduction in costs and we have a tax rate of 50%, then, that has a reduction there, and we're going to have to figure that out. So here's what straight line depreciation looks like: total cost of the asset divided by number of years. So again, that's $2,000 a year. That's what the depreciation would be. And then we're going to put it in this nice little table, and I'm going to load this up so you guys can see this, and you can just copy this table. It is also located in the benefit cost analysis overview. This in cash, in this case, we're looking at cash savings. So we're saving money. So here we go. Here's our annual savings from the net income number. This is how much we make. Then we get, subtract that annual depreciation. This is just the income, the cash we get from the machine. Then we talk about depreciation, which is not an operating cost. So it shows up somewhere else. So that's why it's here being subtracted. So this is our income before taxes, because even though we didn't spend $2,000 this year, we spent that in year 0. This is year 1. We don't get to deduct the $10,000 in year 0. We get to deduct part of it in year 1, year 2, year 3, year 4, and year 5. So this calculation works for every year. That's why we will get a nice annual number that we can then go back and plug in our spreadsheet. This makes it easier for you, and that's why I picked straight line depreciation. So you subtract your depreciation, and you now see an income before taxes of $18,000. You're simply saying the machine is worth less. I took my pencil, I said you're worth less. I show it as money flowing out of my pocket. In our minds in this class, the money has already flowed out, but in accounting purposes, we cannot deduct it till today when we do our taxes. So we subtract it, and then we have a 50% tax rate. So 50% of it, $9,000, goes to pay our taxes, and this is our income before taxes. Then we add back in our annual depreciation, because that was up here, we subtracted it, but we'd already spent the money. So why are we acting like we spent this cash? We've already spent it. So we add it back in, and we come up with an annual net cash benefit of $11,000. What did the machine produce for us? $20,000 a year. But what are we actually going to plug into our spreadsheet? 11,000 because buying and using this machine really let us reduce our tax payment. So that's reducing the cost, sort of, in a way, that year of all the other stuff we're doing. So you're really getting a net cash benefit of $11,000. So this is the table, and this is if you had a savings. It can also go in another way. Maybe you're buying a machine to reduce costs. So then you would kind of, instead of subtracting depreciation, you would add it back in because, and I think this is homework 4, kind of flips it and says, oh, instead of savings, we're doing cost reductions. So similar thing, you just change the signs. So we get this annual net cash benefit of $11,000 every year. So for the private BCA, then that's what you do. That's what you plug in. Oh, I'm not sure. Okay, so there it is again. Okay, so here's the stuff the other stuff covered in chapter 4. And again, we're really talking in chapter 4 about what's the private BCA look like, because it's different than the public BCA. So another thing that comes up in this homework on assignment 4 is working capital. What is working capital? Working capital is money that the business needs to hold in its account to kind of pay bills as they come in. So sometimes when you buy a new machine, there's going to be additional gas costs or electrical costs or maintenance costs or toner or supplies, paper or something. So you might need to assemble more cash. So what's going to happen is the idea is that you may have to stock money in your checking account. So there really would be kind of a cost to making that investment of initially building up a balance, or maybe you can let a balance go down. So you would have an actual source of cash coming in. It's all money, but you're just putting it aside, not spending it if it's sitting in your checking account, that cash cushion, or I don't need that anymore and now I can go ahead and spend that. So if you're doing that, if it says, okay, I need to have from year 0 to year 1, I need to build up working capital, then that shows up as a negative because I'm basically saying whatever this project does, it's gonna cost me $100 year 1 because I've got to just take $100 and let it sit in that account. Of course, I'll get it back at the end, but right now I need to let it sit there and I can't touch it. So I have to show that I have to have an increase in my checking account. So this is really showing up as a negative 100. Then it goes, well, sort of. You need to either take it and put it in there or hold it in there. And it doesn't matter when you turn in your example, if you put a negative here, then you would have a positive here. Because here now you see from 1 to 2, it goes down by $50. So that means I can take $50 out of there. So that's why it shows negative. So I'm taking $50 out of there and I'm putting it now in my pocket and I can spend it. So it would show up as the benefit. In this case, it would show up as a cost, even though these signs may confuse you. So you'd have to take this $50 out of there, or you could leave it in there, but you can take it out. And then you notice it goes back up again. So then we have to get another $100 and put it in there. So that's what it's trying to get you to see, because when you're dealing with private businesses, a lot of times this idea that you have to keep cash in your checking account is a drain because you don't get any interest on that. I myself try to avoid large cash balances in my checking account because I don't get money off of it. I try to put it away where I can't see it if I don't need it. And if I need it, then I bring it forward and I put it in my checking account. And that to me is basically kind of like getting ready to spend. So it will show up as kind of an outflow in my mind or a cash that I have to assemble. And it does have an opportunity cost when I have to hold a lot of cash. So I prefer things where I don't have to hold a lot of cash because there's no implication when you discount, because you're not holding cash earning nothing. If you're holding cash earning nothing, when you discount that, that's going to be negative because you're just non-productive cash, but you're still expecting a return. So projects that require large cash balances are not as attractive as ones that don't. So
So the total working capital, that change from 100 to 50, that's just based on the operation costs of the example. Like, it's not like it always goes down by half and then
no, it will tell you.
it'll tell you. Okay.
I mean,
Okay.
the problem just basically says you need this. What happens to working capital? And if you don't know what working capital is, you'll be going, well, I don't know what happens. So working capital is that amount of cash that you have to hold. So what it asks you in the problem is, does it go up or down? Cash used to build working capital. So here, that went up, here it went down, here it went up. So if you give me this table, I will count that as correct.
Okay.
But when the business goes to put it in their cash flow budget, you see, it's not going to be recorded. This will be a positive and this will be a negative, right? Because this requires me to devote cash, give cash to it. And this, and the next one right here lets me pull cash out and spend. So that's like a benefit.
Mm-hmm.
When I have to stockpile cash, it's a cost. The purpose of the example is to just help you understand some of the peculiarities, because there's 2 or 3 peculiarities of doing private BCAs. Because people are paying taxes and people also have to manage because they're buying and doing projects in order to make money. Governments do not buy and do projects to make money. They do it to benefit the people. So they're not worrying about tax breaks, working capital. They don't have to worry about that. They have the treasury. They just spend away, right? They don't worry about holding back, it seems to me. Or maybe it's just... So it's a simple concept, but if you don't know what working capital is, if you don't know accounting lingo, you're going to be going, what in the heck?
Mm-hmm.
So you see, it's very simple.
Yeah.
It's on assignment 4, and it takes you about 5 minutes once you see this slide to know. If you give me this table, we're done.
Okay.
It's pretty simple. But I just want you to understand about it, because this is our big frustration, particularly in NREM, where we have a lot of people that love government and nonprofit projects. Well, that's great. They don't pay, nonprofits don't pay taxes. The government doesn't pay taxes. And so they don't really have to, and they don't often do things where they're making profits, right? So it's a different ball of wax than when you're dealing with private companies. And if you're going to do private BCAs, you have to understand what those businesses need, because a lot of times they will be the drivers of a lot of economic activity.
Mm-hmm.
So a lot of times when you go down to legislators, they're going to think the world revolves around these businesses.
Right.
And maybe it does, I don't know. But you have to be able to understand their private BCAs, because sometimes the government motivations may not exactly jive with the private. So we have to figure out how to manage all this.
Right.
And if we don't understand how businesses make decisions, we're really, really at a loss. And this is one of the problems we have. I have had social workers in the class, and they go down to the ledge and they don't know how to present their arguments. And getting angry is really not a solution.
Yeah.
So you need to understand, and these private businesses have done their BCAs. You may not see them, but it helps you if you're able to negotiate what the issue is. Like, oh, maybe this requires so much working capital because it's very risky. Maybe what the government could do is help reduce some of the risks. Then the investment would be very attractive. And it wouldn't really cost anybody much money, but you could still get someone to do a kind of a private investment that may benefit a community a lot, but may not be one they want to do because it requires a lot of working capital, because there's a lot of weird stuff that goes on that you need cash, you know, in case bad stuff happens or something. Mm-hmm. This happens, right? That we really want certain businesses in some socially disadvantaged communities, but nobody will nibble. Mm-hmm. So if we can look at their private BCAs and figure out what's the stumbling block, we don't have to give them tax breaks. We can go in there and deal with the specific problem that they're having, which may be a lot cheaper than giving tax breaks. Does that make sense?
Yeah, absolutely. That makes a ton of sense.
Okay, so now borrowed funds. Funds for a project can come again from the owner's money or borrowed money. So for private owners, interest is tax deductible. So I think we've been through this slide about 7 times. So I just wanted to show you an example how you account for that in a private owner, because they will try to fool you. This is why we've moved to accounting standards that are more universal, because people will do funny things like not show, they'll have leases that they're locked in, so it becomes like a debt they have to pay, but they won't show it. So they'll look more healthy than they really are because they won't show some of the things that they're going to have to pay, because that's a financing thing and not a cash flow thing. So I just wanted to run you through an example of what I'm talking about, because I've said these words and I'm sure you're still looking at me like, ugh, what is she talking about? So here's what the deal is. So if you're borrowing debt financing, then you would get cash in year 0, which we don't worry about because it doesn't have to be inflated or discounted or any of those things. And then in year 1, you pay back $100 of the principal, which is really not going to change your net cash as far as your income goes, but it will change it in the end when we get down here. So here's the principal. We don't get a tax break on paying back principal, but we do get a tax break on paying back interest. So we get here what we're paying, because we got to keep track of what's happening with our cash. If we get $1,000 in year 0, then we got to pay back $150 in year 1. Do we count it at $150 because it's a negative cash? Or how do we do that? Well, we count $100 as paying back the principal, $50 as paying back the interest, and then we add in what we save on taxes, because every time I borrow money, it reduces my taxes. So when you borrow this $1,000 and you pay it back in year 1, then what you're really paying back is $150 principal and interest, but then you're saving some money based on reducing your taxable income. So this is why borrowing looks so attractive, because you're really not paying back the full costs, right? You're getting a tax break. So this is why we're into it. The only money I borrow is for stuff that's tax deductible. That is mortgages. Unless it's a mortgage or a home equity, I don't borrow it. That's just how it goes. So, and this is the reason, because the interest is tax deductible. So this $1,000 ends up costing me less to pay back because some of it is tax deductible. And we all know that I've said many times that we're earning more on this, we should be, than more than enough to pay back this $50 in interest and this $100 in principal. That's what that opportunity cost is, enough to pay back what you borrowed plus make some profit for taking the risk. Does it make sense? I don't even think you have this on a homework problem, but I wanted to cover it because I've blabbled about it about 7 times, and I know everyone gets very confused by all the words. And when you see it in these tables, you really see what this means. So sometimes rather get a tax break, sometimes, you know, assistance with financing is possible. If you assist people with financing, you still get all those tax dollars coming in. If a company just can't make it, you know, rather than giving them just a tax break for doing something, maybe tie it to some sort of, get a private lender to loan them money, and then you're still going to be getting a little bit of a tax break and the investment, rather than just straight saying, oh, you don't have to pay taxes. We still want some taxes, but maybe if you can get a private lender to loan them the money so they can do the deal at a good rate, then maybe it's kind of a win-win for everybody. So, well, we have a mindset to give tax breaks. And what I'm trying to avoid is giving tax breaks because it's expensive for the government and the community, therefore, because the community needs taxes to do other stuff. So this is kind of one way that I always recommend that we consider doing it, is by really looking at financing options and trying to get people to, you know, like private lenders to finance. And then we still get some tax dollars and we don't have to give tax breaks. And they get some breaks. Everybody gets some breaks because of this structure. Does it make sense? Sort of.
Yeah.
Yeah. Sort of.
Sort of.
Okay, so we have one more thing. Let me stop sharing that. Where's my share button? Stop share. Now I'm going to share one more thing here, or maybe two. Okay. This is a spreadsheet. So let me blow it up. Okay. Maybe I can blow it up some more. Okay, so there's a function that we haven't talked about that's covered. So it's really trying to figure out loan payments. So there are ways to figure this out with these functions in Excel. So I wanted to show you an example. So let's say you borrow this $1,000 from the bank. And what you're really asked to do is figure out how much principal and how much interest you're going to pay. So this is very important because, again, as I just demonstrated, it impacts your cash flow calculations. So you have to do these separations, and it's going to be different every time because every period you're going to have a different amount that you owe. You pay interest on everything you have borrowed. So the first year, you notice you're paying $100 in interest because the interest rate is 10%. So you borrowed the $1,000 for 1 year, so you owe $100 in interest. But you notice the next year you owe less in interest. That's because you've paid off $302.11 on the principal. So then it comes down. And then by the end of the year, you notice if we sum up all the principal payments, this is a sum, then it totals to $1,000. So we paid everything back and we paid $206.34 in interest. So that's really what you can calculate. And if you look at the spreadsheet, you'll see the formulas pop up. This is a PPMT, which is a principal payment. This is an IPMT, which is an interest payment. So what you do is you put in there B5, which is the interest rate, and then you start telling it what period you're in. You're in the first period. So if I had put just a 1 up here, I could have just clicked on that cell. And how many years is the loan? Total years, 3 years. So I could have put a 3 in this cell and just clicked on that cell. And then what's the starting amount? $1,000. And then these have to do with, do you pay it at the beginning of the period or at the end of the period? And then it will automatically tell you what the principal calculation is for year 1. And if you want to do year 2, you notice the only change I make is I put a 2 there instead of the 1. And then in year 3, I put a 3 and a 3 because it's 3 years total. So that's how you get those without figuring them out by yourself. And if you ever get a loan and you want to figure out what your payments will be, then you use the payment function, which tells you it's B5 again is the interest rate. 3 is the number of years. So if I had not put year 3 here, if I just put 3, I could have just clicked on that. The $1,000, I could have just clicked on this cell right here, which would make it more efficient. And again, these zeros have to be, when are you paying it back? Is it all paid? And so if you're paying an equal payment every year or every month, then this is the calculation that you use. And I believe there's a question on assignment 4 where you're asked to say, oh, I got this loan. How much is principal? How much is interest? How much are the annual payments? And that's how you figure it out. And it's a function called PMT is the total payment for a given interest rate and a given sum borrowed and a given length of the loan. And IPMT is the interest portion of that. For each year, you have to get a new calculation, and then you sum them up here with a sum. And then PPMT is the principal payment. Any questions? Pretty straightforward. but we haven't done it yet. And I want to make sure you know how to use these functions, because it's very good for personal finance or for somebody who's trying to figure stuff out. It's not something we see a lot in government projects because governments, again, don't have to borrow from the banks. But when you got to borrow, you need to really be on top of how fast are you paying down that principal, how much is tax deductible of that payment, which is the interest portion. And so that really matters.
So the payment then, that 402,
Mm-hmm.
that's how much you're going to pay each period, or
Yeah.
that's the total? Okay.
If you add these two up, you notice this totals 402.
Right.
And this one totals 402. And this one totals 402. But you notice by that third period, it's only $36 because you've paid it down. And that's why a lot of times people will confuse avoiding paying taxes with making good business decisions, because they get enamored of this idea that interest is tax deductible. So they tend to get very zealous about borrowing more than maybe they should. That's a problem. So there's that. Anybody has questions? So that should prepare you. Again, if you look at the BCA overview, it has the other option, I believe, where it's cost saving and depreciation associated with that. So you have both options. I think you have a question on there. Let me look at that, because I'm really trying to cover this. Yes, the very first question has purchasing computers. So it doesn't tell you what the benefit is, it just tells you what the costs are, and you're trying to get the net present value of the costs and get the lowest net cost. That's what you're trying to do. So if you look in your BCA overview, and then question 2 is, again, those thorny reinvestment things, which have been driving us all crazy. And then question 3, that this is stuff we've all covered except for one thing, 2 things. Number 1, in question 3 on homework 4, it asks about payback. Payback, again, is a simple concept where you just say, how many years does it take me to recoup my initial investment? There is no discounting. And for average rate of return, this is another thing we did back in the day when we didn't do a lot of discounting. That doesn't, you're not really using discounted NPVs for the average rate of return. You just add them up and divide by the number of years. For project E, it's 4 years, and for project F, it's five years. You just add them up and divide by 5. You know, you add them up so you get your net benefits, right? Divided by your cost. No, you get your net benefits divided by 5, and then that goes over what you spent. So you get your average return. So you add up all the net benefits, divide by 4 or 5, and then divide that by the year 0, the cost. Again, average rate of return, benefits divided by costs. Benefits divided by cost. Again, why are we talking about this? Because these are things that businesses will use, because it's their kind of rule of thumb. Sooner is better than later. Again, one more demonstration that sustainability is not on their brains. What's on their brains? Getting their money back as soon as possible. Because businesses usually have higher discount rates than your average government or community. Community runs on 100-year timeframes. They're willing to wait. Businesses are seldom willing to wait. They got to make payroll. So this is one of the realities that we're facing in being sustainable. Again, so we have to understand the way they think. So this is the point of chapter 4, is to really kind of get our chops down on private businesses so that we can understand the negotiations we're going to have to go through in order to get things to have a mediation kind of area where you have businesses that are really fitting in long-term into the community and not just making profits and leave them. We really prefer long-term relationships. We prefer businesses that are rooted in our communities for 35 years.
So if you were gonna, it's kind of a random question, but if you were gonna work with a company or a business, they would have all of this, but it would just be in kind of funky terms, you mean?
They may not have these cute little spreadsheets,
Mm-hmm.
because a lot of them will not want to forecast 10 years in advance.
Mm.
Right? They'll kind of just do sort of a rule of thumb, and they'll probably only go out about 4 or 5 years.
Mm-hmm.
So they may not actually, a big company like Hawaiian Airlines, for example, would have them.
Okay.
But a small mom and pop is usually not having the cash to invest. They may buy a building. But what will happen is just like farmers. They'll buy this land and they'll sit on it for 35 years, and it looks like they have tons of expensive assets because the land is worth a lot, but it's really not worth a lot for agriculture.
Mm-hmm.
It's really worth that much because of the surrounding development.
Right.
Right? And which caused inflation. It's not because the farm is so profitable.
Mm-hmm.
So accountants spend a lot of time really talking about, so what is the real opportunity cost? So they fuss about this a lot.
Mm-hmm.
So just to let you know that it seems like businesses are, I mean, the really big businesses have people that sit around and do this, so they can pull this out of their ear at a drop of a hat. But when you're working with small community-based businesses, they have a very hard time with this. So sometimes if those are your clients, if you're working with a nonprofit or like an economic development, like a Main Street program where we're really trying to help our businesses do a better job, you may have to come in there and help them do this. Because some of you may be doing that in the future. We need to help our businesses. And some of these little mom and pop operations are really struggling. They don't have access to this cash to do these projects.
Right.
So some of your job is to really go out there and help them creatively understand what this looks like by helping them with their cash flows and understanding what's a good investment and what isn't. Even my farmers will want to buy this new truck. Oh, because I can get depreciation, that reduces my taxes. And I'm like, but does a new truck help you make money? If a new truck produces the same net benefits as the old truck, why are we spending $10,000?
Mm-hmm.
Because we're not going to get the cash flow to pay that back. This happens to me a lot. Like, why are we buying this? If this is not helping me make money, then I shouldn't be buying it. So from the private business perspective, what you're really buying this stuff for is to produce net benefits in the future. But when they don't think like that, a lot of them will just be avoiding taxes.
Yeah.
And that's not the goal. The goal of a business is to make money. And what I tell people is you really are in this for the long term. So you really need to be looking ahead 20 to 30 years because this is a lot of work. Yeah. I have to do that because I buy houses. Those have a 27.5-year lifespan. So I have to look ahead. But for other things, a lot of these people are so consumed getting through their week, and you may actually have to help these people. The large corporations, you may have to battle. Because they're going to come in with all these numbers and these accounting things, and you're going to get very confused how they got those net benefits. Mm-hmm. And I can tell you that I can manipulate numbers to make their net benefits look lower, to make them look like they're not making money. Because who's going to come in and say, oh, we're making a ton of money off of this? Yeah. No, when you want to do a big project and you're a big developer or you're a Walmart, you're going to argue that you're not going to make that much money. And you're going to produce figures that support that claim. And unless you guys know how to go through those figures, they're going to come in and want things from the government. This is normal expected behavior. It's not bad behavior. It's expected. They need to make money. That's what they're there to do. They're not here to be the stewards of sustainability. They may do some stuff, but again, they're overwhelmed with what they're doing, trying to satisfy their consumers. So that's what they're doing. So we need to understand this and not get emotional, but simply trying to map out these net benefits and understand, are they being accurate? And if they're not, we need to be prepared to point out where this is not accurate. And they will come in, like I said, the film industry gets huge tax breaks here. Mm-hmm. But is this really warranted? Do we really make enough money to give them these tax breaks? Because these are people from other states coming in here and making money and going home. They don't live here. And they're not bringing, the top jobs are not going to be here. They're going to be the actors, right? And the directors. What's the probability those people are going to be from here? Pretty low, right? Mm-hmm. Then they're going to go back to California and we're going to give them a tax break?
Right.
Let's think about this for a minute before we start giving away the farm.
Right. I know that's a big problem with like cryptocurrency stuff in Puerto Rico right now. Is now they're changing their mind. They're like, oh my God, we gave you all these lovely tax breaks. We're not charging you any taxes on this, but now you're all leaving. Like
And
none of that money is hanging out here.
And this is what I'm trying to get people to see, that before you start getting tax breaks, let's understand what the private NPV of this project is before we get blinded by their claim that they're going to bring in all these jobs. They can bring in those jobs for 2 years and leave because they have very high discount rates. And you give them enough benefits, the thing will pay out in 5 years and they leave and take it all with them. And we're sitting here with nothing but an old empty factory building that nobody wants. How many old Kmarts do we have sitting around the islands that nobody will fill? It's a lot. It's not beneficial to community to have a bunch of empty buildings sitting around. So this is what we're trying to fight, is this notion that businesses take advantage of things. What I'm telling you is I'm not so sure I would characterize as it taking advantage. But before a government gives a business a tax break, I think I'd be darn sure that I understood what the net benefits of the project were to them. Because again, of course, I'm happy to get more. I'm happy to give all the money you ever want to me. What I complain? If you want to give it to me, I'm not going to complain. But I really can't promise you that these businesses are going to be here in 5 years. So, and that's what Puerto Rico did. I think they also had medical things that they gave a lot of tax breaks to.
Yeah.
Medical, like pill makers, or I don't remember what it was.
Yeah, it was some kind of weird pharmaceutical processing thing.
Yeah, and then they got the tax breaks, and as soon as the tax breaks expired, they all left. And then the Puerto Rican economy, and then you're like, well, then we got a few jobs for 5 years, but we didn't get any taxes, so we didn't really get the benefits we thought.
Right.
So I have a lot of problems with communities trying to do economic development, and they have somehow in their mind they're going to get a save your business or a golden arrow, or I don't know, but it's a problem.
Right.
So this is what we're trying to fight, by educating you to understand how a private BCA looks and how to kind of get some basic kind of feel around that. And before you give away the farm, really look at these benefits and see if they've done them properly and how big they truly are, because it's very easy to be fooled, because they will claim whatever.
Right.
You know, again, accountants, we are moving to international accounting standards, as I said. But particularly if you're working in third world countries, this becomes very, very difficult. Because you really can't be sure what's going on, because sometimes there's just information problems. And there may be, you know, costs that you really or don't know what they're talking about. I mean, you know, that we have to accept. We go to Mexico, we pay more DIDA, bribes. We do. So, you know, we have to understand these things and we have to be careful. And I think governments and people that want to recruit businesses and jobs get a little bit blinded. And I think that they then blame the businesses. And my feeling is that we should go in there armed with the appropriate tools to help legislators and community members understand what's going on. But you know, it's like I had a group in Waianae that was very frustrated because when Ko'olina went out there, they had this negotiation with the Disney group or whoever built that thing, that they were going to hire people from the leeward side to be the employees. Then as it turns out, they hired a bunch of people from the leeward side, but not from the Waianae coast. And I said, well, of course, if you're going to hire someone and you have two choices, one is a hardcore unemployed person from the Waianae coast, or another person lives in leeward Oahu, but drives to Waikiki and is, of course, happy to stay closer to home and work at the resort, which one would you hire? You can't, unless you specifically say you need to hire this group right here, they're not going to do it. You said leeward coast. Stop blaming the business for something that you should have been able to predict. I have no issue with hardcore unemployed, but they need a little bit more training and help. You know, when you're a business and you just want to start right off, you can't blame them for taking the route that's most profitable. If you want them to do other things, you have to be clear about your specifications. Does that make sense?
Yeah. And that comes back to that working capital kind of thing, right? Like they need that working capital right at the beginning.
Yes.
So they can't be dumping it. Okay.
Yeah. So we gotta really be clear what's going on. And this is the biggest problem I see, is that people are not clear.
Mm-hmm.
And they make naive assumptions about businesses because they don't understand them. It's not an emotional operation. It is about making money. If they don't make money, they're not successful. We want them to be successful. The more money they make, the more jobs we have, the more taxes we make.
Mm-hmm.
And if they're making money because the customers want what they have to offer. So we need to be careful before we vilify them. Because if they're making money, somebody's shopping there. So why are they so bad if this is what the community wants? Make sense?
Yeah.
Okay, anyone has more questions? Answers? Woo! Okay, so we have a weekend, yay. Next Tuesday, again, holiday. I'll try and remind, and then we really need to helle on through chapter 5.
Okay.
And then let me know when you turn your stuff in, and I'll grade it for you. I'm pretty quick about grading, aren't I?
Yeah.
Unless it's a Sunday or something. But we just want to make sure everybody's getting caught up, and so we'll be done with most of the undergraduate lectures by next week. Okay, everybody. We're going to stop sharing, and we'll end the meeting, and then if you need, and then I'm going to learn how to use YouTube.
Yay.
Promise. So we can just upload them all so I don't have to be bothered to file them. Okay, bye everybody.
Thank you.
Bye.